There are a million variables that impact financial markets, but there is one that has the biggest impact and not many people are aware of. This is global liquidity. Today we are talking to Michael Howell. Our Bitcoin Brain Trust group interviewed Michael Howell from Cross Border Capital today, who is a researcher and a scholar on global liquidity, and he has developed a global liquidity index that demonstrates very well how the financial markets move up and down in lockstep with global liquidity. In this video, I want to summarize the key points from that interview, which was originally published on Fred Krueger's YouTube channel and Twitter account. It was streamed live, but what I have done is I've taken some parts of it and adding some context and my own takes on top of it. So let's get into the interview and begin with an introduction to Michael.
One of the key things in terms of understanding financial markets was, first of all, understanding how the fixed income markets work, because they're a critical component of that. And the other thing was to understand flow of funds. And Henry Kaufman, who was head of research, is sort of the doyen of flow of funds accounting. And a lot of the stuff he wrote was really trying to understand the backdrop for why interest rates are moving, why financial markets are shifting around, why capital is winging its way around the world. And so basically across border, what we do in sort of further iterations is to understand that money flow and capital flow from a global perspective. So we supply institutional investors worldwide with data and narrative in the operations of central banks in about 90 countries and the movements of capital flows around the world. So we construct a series of indexes, which are called the GLI, or Global Liquidity Indexes. And the name is a clue. And what they try and do is to understand the cyclical movement of liquidity through world financial markets. And it's really as straightforward as that. And a quick heads up to maybe interpreting those. We can split those in terms of different ways: what central banks are doing, what cross-border investors are doing, what private institutions are doing in terms of liquidity creation. We can split it by country. And at the end of the day, the sort of quick heads up is the most important central bank for financial markets is clearly the US Federal Reserve. And the most important central bank for understanding the real economy is really the People's Bank of China. One drives financial asset markets, the other tends to drive commodity markets.
Okay, we also have Stephen Perrenod, astrophysicist from Harvard, and the person who drove me to Giovanni in power law. And we have Sina, also great quantitative research. So all of us are Bitcoiners, Michael. I'm curious where your research has taken you in Bitcoin. We can talk about liquidity in general, but I'm just very curious if you're kind of what your journey has been on the Bitcoin side.
Yeah, well, I think the answer is that it's really been an empirical association of trying to find monetary inflation hedges, and I'll go into what I mean by that in a moment. Traditionally, it's gold or precious metals, which has been the proven monetary inflation hedge over the long term. But it seems to be increasingly the case that Bitcoin is acting like digital gold, and what you see is what you get, and it proved to be a pretty remarkable monetary inflation hedge over the last 5 years. Whenever you see liquidity conditions expanding, Bitcoin tends to move roughly about 6 weeks after you see the first indications of liquidity changing direction. So that's really the journey. And, what it comes down to is really understanding why you get cycles in liquidity, which I can go into, but that's broadly speaking the essence of my, if you like, journey in Bitcoin so far.
And do you own personally any Bitcoin or for your client?
Yes. The answer is, for our clients, we can't invest in Bitcoin, but personally, yes.
Michael collects a lot of variables from central bank action and then the private banking sector and a variety of other variables to generate liquidity indexes. Then what he does is he demonstrates that liquidity follows cycles. And these cycles are very, very regular. Every several months they repeat. And in this part of the conversation, we focus on these cycles, and he mentions that they repeat every 65 months. Once we get a wave of liquidity, all assets go up, and then once the wave subsides, we get weakness across the markets.
Why cycles? Why they are so regular? Because you will expect to be much more chaotic, right? Because money is moving from one place to another. There are particular reasons for it. But why the cycles? Why they are so precise?
Okay. Great question. Let me try and have a stab at that. I mean, basically what you've got, if you pick up an economics textbook, is a view of the world which is very archaic, very out of date. And what it says is that economies are driven by capital spending, and capital spending is attenuated by interest rates. In other words, financial markets act as capital raising mechanisms for capex spending, and that capex spending is the driver of economies. And therefore, given the fact that the depreciation cycle of capital goods is about 9 to 10 years, that's why a lot of economists come down to the view that you're looking at a 9 to 10 year economic cycle. That's the basic business cycle view. Now, my view is that that's wrong, and it's wrong because things have moved on. And if you go back 50 years, let's say, to the 1970s, during that decade, which was fairly representative, out of every 3 transactions in financial markets, 2 out of every 3 of those transactions was a capital raising transaction. So in other words, it was raising money for new capital expenditure. So that was the textbook model. Today, if you look at financial markets, 4 out of every 5 transactions are refinancing transactions of existing debt. And only 1 out of 5 is a new financing transaction. So in other words, financial markets today are no longer new capital raising mechanisms, they're debt refinancing mechanisms. Now, if you look at the stock of debt worldwide, which is eye-wateringly large, you've got something like $350 trillion of debt sitting on our backs in the world economy. And the average maturity of that debt or duration of that debt is about 5 years, which means that simple math says you've got to refinance on average $70 trillion of debt every year. Now, that's a huge ask for the financial system. And it doesn't matter about interest rates. What matters is the capacity of the financial system. In other words, the liquidity base of the financial system to roll that debt over. And that's really the essence of this view. So in other words, the 65-month cycle pretty much aligns with the frequency of the debt refinancing cycle. Now, there will be differences there because you can get, it's true that on average, 70 trillion is refinanced every year, but in some years it might be 60, and in other years it may be 80, and some years it may be 90. So you've clearly got a change there. But broadly speaking, that explains why the cycle is moving. Now, what's driving that cycle is increasingly the public sector, because the public sector's creation of debt is just becoming eye-wateringly large. And to give you a sort of heads up, for example, US public debt outstanding has increased 8-fold since year 2000. Interestingly, the dominant monetary inflation hedge, which is gold, has increased over that same time frame by about 8.5 times. So gold has matched. Very, very few other assets have got anywhere near that. And so what's happening is the whole financial system is basically creating liquidity to finance debt, or to help roll over debt, I should say, not to refinance debt. And that process is creating, over time, an increasing trend of monetization and liquidity. And that's why you need in portfolios monetary inflation hedges like gold and, I would argue, probably Bitcoin.
So Michael makes the point that Bitcoin's growth is a function of global liquidity, which is perfectly accurate. But something we really wanted to mention here was also that Bitcoin has 2 forces behind it. First of all, it's the global liquidity, which is the force behind growth of many financial assets, including gold and stock market. But also Bitcoin has this additional power behind it, which comes from the fact that it's a very new network. It's a nascent network that is being monetized, and it's gaining more and more popularity. and more adoption over time. And that follows a power law pattern. Now, it's very important to understand how they come up with their global liquidity index, which is very interesting and exciting to us. And I think the approach here is they collect a large number of variables from central banks and the private banking system and so on. I think you have captured one of the most important metrics in the whole financial world. There's a lot of detail, but there is this big elephant in the room that not enough people are talking about. So great work there. But what I really want to understand is if, because, we have this general relationship between liquidity and assets, but I've also heard you, go into further detail about the components that form, or essentially there might be a lot of things, but the big components in the liquidity bucket, I want to see if, you've broken these down into specific buckets with different effects. So we are probably thinking about different sources where liquidity comes from, and these sources might have different transmission mechanisms and different effects. Okay, so first question is, what are the big buckets where the liquidity comes from, and what's the transmission process? And the second question is, how is the effect on financial assets different from these different buckets? So you already have done some great work in measuring the reaction of Bitcoin and gold and stock market to liquidity. Have you also looked at, smaller sources of liquidity and how they affect different asset classes?
Yeah. Okay. Well, let me say first up that, thanks for your kind words. I didn't discover liquidity. I think liquidity is a concept that I would really say was a Salomon Brothers concept. And what we've tried to do is make it just a little bit more tangible by trying to actually collect the data and supply that data and try and sort of fashion a narrative around what's happening. So that's pretty much what we do. To step back one step and to come back to a point that Giovanni was making, I would tend to think about this, the move in Bitcoin as really having two moving parts. And let me think of it this way, as an intensive margin and an extensive margin. So number one is more people adopting, right? So you're looking at more and more people using Bitcoin, having their $100 in Bitcoin. And then an intensive margin where that $100 in institutions becomes 100, 1,000, 100,000, a million, or whatever it may be. Now, I would tend to think that the first of those, the extensive margin, is following maybe an S-curve adoption process or something akin to that. And the intensive margin is much more about protection against inflation or monetary inflation. So I think there are two factors which are driving the price of Bitcoin, which are coming together. And that maybe is why we're looking at the confluence of these cycles right now. And that may be a case. Now, to step back and to say about what we're collecting and how it impacts assets, we look at different slices of liquidity. So we tend to generally think about the financial system creating liquidity from, if you like, a primary base. And that primary base principally consists of what the central banks do in terms of liquidity generation, and also what collateral there is in the system, for which private banking organizations or private credit facilities can actually create credit themselves. So if you like, there are two moving parts in this equation. And therefore, in terms of understanding the liquidity cycle, in our view, you've got to understand what the central banks are doing. And the second thing is you've got to understand what the private sector is doing. Now, we monitor what the private sectors are doing, but very generally it comes down to understanding the collateral pool. So that's things like US treasuries, the value of treasuries, the value of high quality assets that can be collateralized. And the other thing is then understanding the haircut that those collateral assets get for credit providers. Now, the size of that haircut tends to be very closely related to volatility in the markets, but particularly things like the MOVE index. So one of the things that we've been, schooling a lot of our clients in is to say, look, you've got to look more and more at the MOVE index, measure of bond market volatility, to understand the liquidity cycle rather than the VIX index, which is the traditional measure of equity volatility. MOVE and bond markets are much, much more important in this whole equation. What we can do from that is then understand the dynamics of what central bank liquidity is doing what private sector liquidity is doing. And within the private sector, we can identify cross-border movements of money. Now, if you then start to say, well, okay, what's really important in different areas? The research that we've done so far, let's say, look, this is a big area, and we're just scratching the surface. Central bank liquidity, and this is something that I first discovered at Salomon Brothers way back in the late 1980s. Central bank liquidity tends to drive the slope of the term structure, and you can see yield curves basically moving within a few months of changes in central bank liquidity. In other words, if the Fed is easing and pumping in liquidity, the yield curve starts to steepen. Lo and behold, what are we seeing now? Exactly that phenomenon. In terms of what the private sector liquidity is doing, and private sector liquidity can be things like corporate cash flow, it can be things like bank or shadow bank lending or whatever. That tends to drive increasingly, or is increasingly obvious where it comes up, is in credit markets. Private credit markets tend to get a big lift from that. And then you look at cross-border flows, and cross-border flows tend to have their biggest impact on things like emerging markets. So if you're looking at cross-border flows of money into, let's say, Asia, that tends to be a big driver of Asian risk assets. So far, those are really the capsules or the compartments that we've managed to find. That's the sensitivities.
But then they break it down into country-level components, and they assign certain weights to them according to the importance of that country relative to their share in the Forex market.
Now, do you give different weights to these contributions? And if so, how do you calculate this weight? They are based on...
Well, okay, to get into the weeds of this, there's a book that I wrote about 5 years ago, which is called Capital Wars, which happens to be the name of our Substack. And Capital Wars basically goes into detail of how these indexes are put together. Basically, we keep, if you like, 3 sets of data. We keep nominal dollar or Swiss franc or euro or yen denominations of liquidity. So we've got that database. And then we've got another database, which is what we call a flash database, where we basically gather data, but we never revise that data. So the first stab of the data is basically what you get in that database, a frozen database, and that's what quants want. And then the third iteration is then to create indexes out of those data pools. And we have various measures of liquidity, and we weight them together using largely through principal component analysis.
Okay, so it's actually based on some kind of cross-validation of the data, and
correct.
And you extract the information directly from the data. You don't do it a priori. Okay, that is cool. This is why I love your approach, because it's exactly what a quant will do, like the more scientific way of doing it, instead of, technical analysis or some other hand-waving way of doing it. So I like it a lot.
So you're combining, say, a large number of variables into a single one, or you using the PCA, you divide it into several subcomponents?
Well, let me correct that. Basically, if you're looking at an individual country, to create a liquidity index, so we'll look at 2 ways, right? The first thing to say is that let's take the US. So for the US, we've got an aggregate, which is US liquidity in dollar terms. Now, in magnitude, that is going to be dominated probably still by shadow banks, right? Conventional banks will have a large slice of those. I'll give some spurious but convenient statistics. Let's say out of 100% pool of US liquidity, 50% is basically shadow bank lending, 40% is bank lending, traditional bank lending, and 10% is what the Federal Reserve is lending. Okay. Now, what we know is actually the Federal Reserve is more important than any of those other elements. So we've got to try and work out some sort of weighting system. And what we do is we use principal component analysis to create an index of the intensity of US liquidity, right? And we do that for every country. Now, when we combine the indexes together into our global liquidity index, they are weighted together by the dollar share at a fixed point in time. So we basically have 10-year windows. So we had an index base at year 2000. We've just gone to year 2020 weightings, and then we're do another one if I'm still around in 2040. But basically, that's how it works. And we had an original one for 1980 weights.
Very interesting.
Does that answer the question?
Yeah, so dimension reduction at the level of country and then combining country level indicators.
Right.
Stephen also asks a great question about the reason to look at liquidity compared to, and especially the way they define it, compared to more traditional measures like just M2 or economic growth or inflation. And Michael has a great answer.
I'm just interested in your take, Michael, on why liquidity is a superior metric to the growth measures and the inflation measures that we often hear other people talking about in the macro world. What do you think is the outstanding reason for that? And then how do those differ in timescales as well? I mean, you've talked about your timescale, but are those slower moving processes, and why are they less important?
Well, I think why do we look at liquidity? Because liquidity is sort of, I think, the primary engine of what's driving all this. It's a reflection of the size of the monetary system or the financial system, and liquidity is number one a credit measure. So we're looking at the asset side of credit providers' balance sheets, and credit providers are no longer banks. If it was as simple as looking at banks, we'd look at M2, but M2 is an archaic definition simply because banks are no longer the main sources of credit in either the US economy, particularly the US economy, and also in the world economy. So, I mean, they're probably responsible for maybe under 40% of total credit supply. Other organizations are important. So that's number one reason for looking at liquidity. And number two reason is that, as I tried to argue, high street inflation is not the same as monetary inflation.
So then we get to the, in my opinion, the core of the conversation that explains that price of gold and Bitcoin are actually largely driven by liquidity, and liquidity is increasing and ever increasing and actually accelerating.
But what is really driving the price of gold and the price of Bitcoin, I think, or certainly part of the drive in Bitcoin, is this monetary inflation. They're monetary inflation hedges. And we have got a serious amount of monetary inflation to tackle in the next few years, because basically I think global liquidity is expanding at an 8 to 10% annual rate, and that compounds pretty quickly. The stock of liquidity is doubling every 7 years. What that means is that if the stock of liquidity is doubling every 10 years, then what you've got is, every 7 years, then you've got a situation where gold is doubling every 7 years, where Bitcoin is more than doubling every 7 years, etc. And these are powerful dynamics.
So liquidity is expanding at a rate of 8 to 10% a year, and that kind of puts a minimum growth rate behind gold and Bitcoin. But these assets also respond differently to growth and liquidity. And Michael has measured the sensitivity of different asset classes to growth in liquidity, and he has found certain multipliers. So for every X amount of increase in liquidity, you've calculated the corresponding effect on Bitcoin and gold and other.
The multipliers are basically for historic. These are regression factors. So one's got to give up a health or a wealth warning. The regression factors for gold is about 1.5. So for 100% increase in liquidity, you get 150% increase in gold. Okay. For historically, for Bitcoin, it has been 4.5. So for every 100% increase in liquidity, it's been a 450% rise in Bitcoin. Now that, as I say, includes a lot of adoption effects. So you can't extrapolate that going forward. But it's a big figure. It's bigger than gold.
So essentially, I guess the core statistics that you can take away from this conversation is that global liquidity is growing at a rate of near 10% every year. And different asset classes grow because they respond to liquidity. Gold, for example, grows as liquidity increases, but it has a multiplier. For every $1 of increase in liquidity, gold grows by $1.5, meaning it has a 50% extra growth compared to liquidity. But Bitcoin, very interestingly, grows by $4.5 for every dollar of liquidity. So it's very sensitive and 3 times more sensitive to liquidity than gold. Essentially, liquidity train is unstoppable and growing at an extremely fast pace. And Bitcoin is the fastest horse to ride to beat this expansion of liquidity and outperform all financial markets. Okay, guys, I hope you like this. I think the message here is very clear. I also wanted to quickly mention that at 21st Capital, we provide a range of services. If you have any question or concerns about Bitcoin, we are here to help. You can book free meetings with us and discuss your questions, and we'll route you to the right experts. We also provide custody services. If you want to explore the services that we offer for custodying Bitcoin, definitely visit our website. And in the coming weeks, we will have very exciting announcement to make about our services. So tune in for that as well, and I'll see you in the next video.